Well, welcome back to financial accounting and financial accounting and analysis. Get that right? And let's just finish up with mini lecture C for chapter 8. So we've been talking about investments in other companies, and now we're going to talk about a particular type of investment in other companies. They're called joint ventures and special purpose entities. We've referenced special purpose entities before. That's a company set up to perform a particular service for another company. So let's talk something new, a joint venture. There's an example of a joint venture in your text discussing the relationship between Starbucks and PepsiCo, where they join resources to market a new type of coffee outlet. So it's a partnering arrangement when one company and another company join together to provide a service. They can combine their skills and resources, and we're going to use the equity method of accounting. So we're going to use to account for the joint venture. The joint venture usually, if it's joint, then neither party owns more than 50%. So we'll use the equity method of accounting. SPEs, special purpose entities, or special purpose vehicles. Classic example of this would be a automobile company that sets up a special purpose entity that buys all the receivables from the dealers. So that would be a legitimate purpose. But there was a lot of abuse of these special purpose entities, and they had been used as a way to keep debt off the company's balance sheet. So again, many things came as a result of the Enron scandal, and one of those was the very much tightening of the rules in terms of requiring companies, if in fact they set up a special purpose entity and they really control that entity, and that entity could not stand on its own, then they're going to be required to actually consolidate the special purpose entity with the parent company. So these are separate legal entities created by the parent. They're usually for a legitimate purpose, other than just keep debt off the balance sheet. And another label that they have is the variable interest entity, and that was the term that's increasingly in use since the rules were tightened in terms of requiring companies to consolidate. So current US GAAP does not require consolidation if specific conditions are met. And for our purposes is that if that special purpose entity could stand on its own, could provide its own financing that wasn't totally dependent upon the parent, then it's fine to use the equity method of accounting. But if that's not true, the rules have been tightened. So now if that special purpose entity could not stand on its own, then the results and the financial statements of the special purpose entity need to be combined with the parent through consolidation. And we would have seen it in Part B, when you go through and do full consolidation, then the debt of the subsidiary is included with the debt of the parent on the consolidated financial statements. All right, let's talk a little bit about foreign currency issues. This is a topic for advanced accounting, but we'll touch upon it here. So we all, foreign currency, we all know this is basically a currency from other countries. And we have special issues how we have to account for this when we've got a company that's got operations overseas. And the operations overseas are going to be carried out in, say, the peso or in terms of the euro, and then the parent is if it's a U.S. company, the parent's financial statements are going to be in dollars. Well, when we get to the end of the year and we've got to consolidate the financial reports, we're going to have to take the financial statements of the foreign entity and we're going to have to combine those with the parent, and we're going to have to go through conversion. So this is what we mean by currency rate fluctuations. So if the peso goes up or the peso goes down. So basically, this is counterintuitive. What happens is if the dollar comes stronger against the peso, then actually you're going to have a foreign currency loss. And this is one of the things that's quite surprising, because you say, hey, the dollar gets stronger, that's good. But when you actually translate it, if the dollar gets stronger, you're actually going to end up with a loss. So you're going to have gains and losses. So the dollar can get stronger, the dollar can weaken. And you might ask yourself, well, why go through all the aggravation of locating plants overseas? Well, you can go anywhere from just having a sales office, or you can have an entire operating subsidiary. So why would you do this? Well, you get a large pool of inexpensive labor. Materials might be a lot cheaper. and you can structure it in such a way that you could avoid potential losses that may come as a result of currency exchange movements. So let's assume there is currency rate fluctuation. Okay, so we do have the problem when we have countries which the currencies you don't have this problem. Like if the U.S., I think it's in Bermuda and I believe Costa Rica, I think Guatemala, where the dollar and the peso in those countries are actually pegged to one another. So if your two currencies are pegged to one another, then you don't have this issue of foreign currency gain or losses. But if they're not pegged to one another, you do. So the financial results of the subsidiaries have to be converted from the local currency to the currency of the parent company. And depending upon which way it goes, whether the dollar strengthens or the dollar weakens, you're going to have either gain or loss. And we're going to term that we're going to use is we're going to have translation, and we're going to account for this. We're going to have an exchange gain or loss, and this is going to flow through that other comprehensive income account. So again, remember this when you do the first discussion question in terms of what might be in that other comprehensive income. All right, so if we've got a foreign subsidiary and their self-contained business units, we're going to have these currency gains and losses. And we're going to have to translate the financial statements that are denominated, say, in pesos. We're going to have to convert those to dollars. And the question is, well, when you convert them, what rate do you use? Well, the answer is it depends. So assets and liabilities are going to have to be translated as of the balance sheet date. So all the assets and liabilities are going to be converted at the balance sheet date. Stockholders' equity is going to be at the historic rate when the subsidiary was established. And on the income statement account, since these are transactions throughout the year, you're going to actually convert these at the average exchange rate that existed for the fiscal period. All right, so we know that this is a result of changes in the value, and they're going to represent unrealized wealth changes. So when you hear unrealized, that should ring a bell now. That should ring a bell. If I have a little bell here, I'll ring it. So unrealized means that we haven't, something, we're going to recognize something on the financial statement when the transaction actually isn't complete yet. So unrealized gain, which means that the assets are going to be, assets and liabilities are going to be adjusted, and we're going to have some place in the stockholders' equity where we're going to account for them, and that's going to be that additional other comprehensive income account. So we're going to report this on that special section of the company's balance sheet. This is the same place where you had all those things having to do with securities. Anytime you had unrealized gains or losses, you adjusted, or in several cases, you actually adjusted the other comprehensive income account. Just a couple of quick things here on the analyzing intercorporate investments. So how do the international rules differ? Well, in general, that's a good ambiguous term. Very similar to GAAP. So passive investments under both are accounted for market to market. And we use the equity method for non-consolidated investments. We have significant influence. Where they differ is with consolidation. So GAAP says if you own more than 50%, you must consolidate. Whereas IFRS, they say, look, you should consolidate when you have effective control of the subsidiary, regardless of whether or not you own you own more than 50%. So you could have a case under international GAAP where you, under their rules, you have to consolidate even if you own less than 50%, because you really have effective control over the entity. In terms of looking at this from a tax perspective, so unrealized gains and losses, we recognize them on the income statement, but they're not recognized for tax purposes. All right. So trading securities, unrealized gains and losses, equity method for unconsolidated subsidiaries, we use those for financial statement purposes, but not for tax purposes. Okay. Dividends are treated differently. So most dividends from other corporations are not taxed, because if you think about it, that would be triple taxation. So the subsidiary has to pay tax. The people who receive the dividends have to pay tax. And then now the entity that receives the dividends got to pay tax on them again. So dividends are treated very differently under tax law than they under US GAAP. And interesting here, consolidation is not required. So under U.S. tax law, if you own more than 50% of the subsidiary, for tax purposes, those subsidiaries can still file their own individual tax returns. They're not required to consolidate. Okay, so that concludes Chapter 8. I'll do a separate little briefing to get you ready for positive experience on the homework. So at this point, before you do the homework, you might want to kind of go back and reflect. And remember that slide 6, and I think it was 16. So whether you print out slide 6 or you print out 16, please have one of those in front of you when you try to do the homework, which I'll do a separate briefing for. Okay, so until next time, adios, au revoir, hasta luego. We will see you shortly for your homework briefing. Be well, everybody. Have a great day.